Hi everyone, I am Adrian and welcome to this channel. Thank you for joining me today for this deep dive into performing an effective Treasury audit. In today's volatile economic landscape, with fluctuating interest rates, geopolitical risks, and rapid technological change, the Treasury function is more critical than ever. It's not just about managing cash, it's about safeguarding the lifeblood of the organization. A robust Treasury audit isn't a box-ticking exercise. It's a strategic imperative that provides assurance over the organization's financial stability, liquidity, and risk exposure. We will move from high-level planning to detailed execution, giving you an actionable framework you can apply immediately. First, we'll define the scope and objectives of a modern Treasury audit. Second, we'll dive into the key risk areas you must cover. Third, we'll walk through the pre-audit planning phase. Fourth, we'll get into the nuts and bolts of the fieldwork and testing procedures. Fifth, we'll discuss how to report findings and drive meaningful remediation. And finally, we'll wrap up with key takeaways. Let's begin. The primary objective of a Treasury audit is to provide independent assurance that the Treasury function is operating effectively. This means ensuring that financial risks are properly identified, measured, monitored, and controlled. Policies and procedures are not only written, but are consistently followed. Transactions are authorized, recorded accurately, and reconciled promptly. The company is compliant with internal policies and external regulations. Now, for scope. Treasury is broad, so you must be targeted. A typical audit scope includes cash and liquidity management. Are we optimizing our cash position? Debt and financing. Is our debt structure sound and compliant? Foreign exchange and interest rate risk. Are we hedging appropriately? Bank relationships and account management. Do we have control over our banking infrastructure? Investments. Are surplus funds invested per policy and in safe instruments? Technology and systems. Do our TMS or ERP systems have adequate controls? Remember, the scope should be risk-based. If your company has significant international operations, FX risk will be a major focus. If it's highly leveraged, debt will be your priority. Let's break down the key risk areas one by one. First, cash and liquidity management. The risk here is simple but severe. Running out of cash or having idle cash that isn't working for the company. Key controls to test. Daily cash positioning accuracy, bank reconciliation timeliness and quality, accuracy of cash flow forecasting models, and authorization for intercompany fund transfers. Ask yourself, can the company meet its short-term obligations? Are there any unexplained, large, or old reconciling items? Next, debt and financing. The risks include breaching covenants, paying excessive interest, or having an unsustainable capital structure. Key controls to test. Review debt agreements for key terms and covenants. Verify that covenant calculations are accurate and reported on time. Confirm that all borrowing and repayment transactions are properly authorized. Check the accuracy of interest expense accruals. Red flag. A debt covenant calculation that is done manually on a spreadsheet with no secondary review. Now, financial risk management, specifically foreign exchange and interest rate risk. The risk is financial loss due to market movements. Key controls to test. Examine the hedging policy. Does it define risk appetite, authorized instruments, and counterparty limits? Verify that all derivative transactions are properly authorized and recorded. Test the effectiveness of hedge relationships if using hedge accounting. Confirm that valuations of derivatives are performed independently and are accurate. Crucial point. The goal is not to eliminate risk through hedging, but to manage it to a level the company is willing to accept. Then, we have banking and security. The risk is fraud, unauthorized payments, and data breaches. Key controls to test. Review the bank account mandate. Who is authorized to sign? Confirm that online banking users are reviewed periodically and that former employees' access is revoked promptly. Test the controls around wire transfers, especially dual-factor authentication and dual approval processes. A must-do. Obtain and review the company's global bank account list and reconcile it to the general ledger. You'd be surprised how often forgotten accounts are discovered. Finally, 2 critical areas: investments and technology. For investments, the risk is loss of principal. Test that all investments are made in accordance with the investment policy regarding instrument type, credit quality, and duration. For technology, like a treasury management system, the risk is flawed data and broken processes. Test user access controls, system reconciliations to banks, and IT general controls over the TMS. Failing to plan is planning to fail. This phase sets the stage for everything. Step 1. Understand the environment. Read the Treasury policy. This is your Bible. Does it exist? Is it up to date? Is it approved by the board? Review prior audit reports, both internal and external. What were the findings? Have they been remediated? Analyze organization charts and process flows. Understand who does what. Step 2. Risk assessment and scoping. Based on your understanding, formalize your audit scope and objectives in a planning memo. Hold a kickoff meeting with the Chief Treasurer or CFO. Discuss the audit's focus, timing, and their view of key risks. This builds rapport and manages expectations. Step 3. Develop your audit program. This is your detailed checklist. It should list every control you plan to test, the population you'll sample from, and the testing procedure you'll use. For example, test: wire transfers are dual authorized. Procedure: select a sample of 25 high-value wires from Q3 and inspect the approval log in the banking system. This is where the rubber meets the road. You are now executing your audit program. Golden rule: trust, but verify. Do not rely solely on what you are told. Your job is to inspect evidence. Let me give you some powerful testing techniques for common areas. For bank reconciliations, don't just look at one. Select a sample from different entities and different months. Trace reconciling items from the reconciliation to the subsequent month's rec. Are they clearing? If not, why? An old, unexplained item is a major red flag for errors or fraud. For debt covenants, select a few key quarters. Reperform the covenant calculations yourself from source financial data. Compare your result to what was reported to the bank. Any discrepancy is a significant finding. For wire transfers, use data analytics if you can. Extract all wires for a period and filter for just below dual authorization thresholds. This can detect control avoidance. For your sample, inspect the system log that shows the 2 distinct user IDs that approved the payment. For derivatives, obtain the dealer confirmations from your company and directly from the bank. Match them. Any differences in notional, rate, or maturity. This tests valuation and validity. Documentation is key. Your work papers must be clear, concise, and repeatable. Another auditor should be able to pick them up and understand exactly what you did and what you concluded. Your findings are useless if they aren't communicated effectively. The goal of the report is to drive action. 1. Drafting findings. Use the classic framework. Condition: what is the problem? Bank reconciliations for the European subsidiary are not reviewed or signed off by a manager. Asterisk. Criteria: what should it be? The Treasury policy requires all reconciliations to be reviewed and evidenced by a second person within 5 business days. Asterisk. Cause: why did it happen? Lack of trained backup personnel during the manager's vacation. Asterisk. Effect: consequence. What is the risk? This increases the risk that errors or fraudulent transactions could go undetected for an extended period. Asterisk. Recommendation: what should be done? Implement a formal cross-training program to ensure review coverage during absences. Asterisk. 2. The Exit Conference. This is a critical meeting with management to discuss your draft findings. Present them fairly and listen to their perspective. They may provide context you missed. Be firm on the risk, but collaborative on the solution. Third, final report and management action plans. The final report should be clear, factual, and risk-ranked. Most importantly, for every finding, you must secure a management action plan, a commitment from management on what they will do, who will do it, and by when. The audit isn't over when the report is issued. True success is measured by successful remediation. As we bring our session to a close, let's recap the key messages. 1. A Treasury audit is a strategic, risk-based exercise. Focus on what matters most to your organization's financial health. 2. Your greatest tools are the Treasury policy and a well-designed audit program. They are your roadmap. 3. Testing is about inspection and verification. Go beyond inquiry and observation. 4. Effective communication and collaborative remediation are what turn your audit from a compliance report into a value-add activity. A successful Treasury audit doesn't just find problems. It strengthens the company's financial defenses, enhances operational efficiency, and provides the board and executives with the confidence that the company's liquidity and risks are well managed. Thank you for your time and attention. If you found this video as useful, please do subscribe to this channel and share it with your colleagues or friends. See you again. Goodbye. Hi.